share my screen. Okay, hopefully that's working. Can you see my screen now?
We sure can. Thank you, Josh.
Okay. Well, thanks for the introduction, Catherine, and thanks for giving us the opportunity to speak to you all today about one of the most riveting topics imaginable, liability insurance for businesses. Since we're going to be talking to you from the biased perspective of having represented policyholders in disputes with their insurance companies, in fairness, I should mention that our insurance company adversaries would advise you to disregard everything we say today. I'll go over a quick overview. We're going to be talking in terms of 4 major categories. The first, anatomy of a liability policy. This is just nuts and bolts provisions to be aware of in these types of policies. The application process, which is absolutely critical, and it is a source of many unforced errors that we've seen. So hopefully you can avoid making some of the same mistakes we've seen. What to expect in the claim process, including the importance of timely reporting and handling denials. And the number 1 rule is never take a denial at face value.
Okay, and Josh, are you able to do the slide sharing with me? If not, you're going to be in charge because I'm not seeing that. But anyway, thank you. Okay, so we're going to start off by defining what a liability policy is, and then we'll discuss some key concepts surrounding liability policies that you need to understand in order to understand parts of our presentation, but also to understand what it is you're purchasing. Too often, policyholders choose a policy based on premium largely, and they say, oh, well, this premium is a lot lower than all the others, I'll take that one. And they don't understand that perhaps that is a reimbursement policy, not a duty to defend policy, or that has a retention rather than a deductible. So it's important that you understand these concepts so you can compare apples to apples rather than apples to oranges. So the first concept is, what is liability policy? These are also often referred to as third-party policies, and these are policies that cover your company when it's being held liable for loss or damage to a third party. So examples of these policies are commercial general liability policies, directors and officers, errors and omissions, employment practices liability policies, and also certain aspects of a cyber policy. So cyber policies may cover you if your customers sue you because their data has been exposed on the internet. That would be a third-party coverage in a cyber policy. In contrast, first-party policies will cover your company when it directly suffers a loss. For example, the factory burns down, or maybe all of the data is lost and needs to be reconstructed. Those are examples of first-party policies. So think of a first-party property policy. One of the concepts that you need to understand is the distinction between an occurrence policy and a claims-made policy. So in occurrence policies, I think policyholders are typically familiar with. General liability policies are typically almost always occurrence policies. So occurrence policies, the trigger of coverage is when did the damage occur? When did the injury occur? Or possibly when did the act that caused that injury or damage occur? And so, as you can imagine, there are situations where something may have happened years ago and only recently is a lawsuit brought. This is very common in the environmental context and also in some of these sexual abuse cases. So we've been recently helping clients with coverage under policies from the 1970s, the 1980s, the 1990s. So it's very important, you as counsel for your companies, you should make sure that your company keeps track of all of its occurrence policies, because you never know if your company is going to have to reach back 20 years for coverage for something. And I can tell you from experience, it is difficult to track down what insurer was on the risk 20 years ago if you don't actually have the policy. It's not impossible, but it certainly makes your job more difficult. Under these types of policies, you must tender, but it's a very lenient standard. You generally have to tender as soon as practicable. Sometimes it says as soon as possible. They mean similar things. And basically, you're not going to lose prospective coverage unless the insurance company can prove prejudice, which is typically very difficult for it to do unless you tender after the lawsuit has been resolved with a settlement or a judgment. Pre-tender defense costs, however, will not be covered. So typically, there are exceptions, but so therefore it's very important that you tender as soon as you can, because if you defend half the lawsuit and then you tender, you're not going to get your pre-tender defense costs. And typically the defense is outside of the limits. And what that means is, like your commercial general liability policy, you have $1 million in limits, and you can spend $1 million defending the lawsuit and you still have $1 million to settle or to pay a judgment. Claims-made policies are very different creatures, and a lot of times policyholders don't understand how they work until they find out how they don't work. So claims-made policies, coverage hinges on the claim being made during the policy period. That's how you know which policy is on the risk. The claim is made during the policy period. And timely reporting is typically a condition to coverage. So the policy will say you must report to us a claim either within the policy period or 30 days after the policy expires, maybe 60. Every once in a while, a policy will actually say within the policy period, and in any event, no later than 20 days after the claim is made. So if you have a policy like that, you always have to have in the back of your mind, this may be a claim and I need to tender. Just like occurrence policies, pre-tender defense costs are not recoverable, but post-tender defense costs are not going to be recoverable if you don't strictly comply with the reporting requirements. Also, typically with these types of policies, and these types of policies are D&O, E&O, EPLI, these types of policies, typically every dollar you spend on a defense is one less dollar you have to settle a case. So it's very important, if you're managing litigation and you have a burning limits policy, it's very important that you keep track of how much defense costs are currently, and really communicate with your defense counsel that you want to get this wrapped up sooner rather than later. Too often, Josh and I have seen cases where the client comes to us and defense counsel has burned through most of the $1 million in limits, and then they're telling the insured, oh, you need to settle because, and we're a little bit cynical, but we think, yeah, they're telling them they need to settle, not only because they're facing liability, but that's the same liability they faced $900,000 ago, but counsel's concerned about not getting paid if they go to trial. So you really need to keep in your head how much has been spent on defense costs with these types of policies. Another key concept is your policy a duty to defend policy, or is it a reimbursement policy? So duty to defend policies, the insurer has the right and the duty to defend. What that means is the insurance company gets to choose counsel generally. And it will choose what's called its panel counsel. So they have panels of counsel that contract with the insurance company to defend all of that insurance company's policyholders. And under this scenario, the lawyer has a dual loyalty. It's called the tripartite relationship. It has a duty of loyalty to the policyholder, but also to the insurance company. Now, many panel counsel are very good about not putting the insurance company's interests ahead of the policyholder, but we've seen that happen. So that's the downside of a duty to defend policy. The upside is it covers typically 100% of the defense costs. Now, that is subject to oftentimes a reservation of rights. So the insurance company says, in the event it turns out there's no coverage or there's no duty to defend, we reserve our right to claw back those defense costs through a lawsuit. But there's also, if there is a right to independent counsel, which Josh will talk about in a little bit, but if there's a reservation that triggers that right, then the insured can go out and defend, choose its own counsel and defend. But the problem is that the insurance company doesn't have to pay the rates that your company contracted, which could be $400, $500, $600 on up for the hourly rate of defense counsel. The insurance company says, well, under the statute, I only have to pay the rates that I typically pay counsel to defend this type of lawsuit. And that's going to be panel rates. And in some cases, like for example, in connection with commercial general liability policies, panel rate is still in the 200s. So if you are entitled to independent counsel under a commercial general liability policy and you go out and you hire someone who charges you market rates, there's going to be a large delta that your company is going to have to pay. Reimbursement policies are very different creatures because the reimbursement scenario, your company goes out, hires counsel, the insurance company must pay reasonable rates. Too often they argue that reasonable rates are the panel counsel rates that they pay, and there are good arguments that that is not the case. So then you have to push back and convince the insurance company to pay higher rates, which are still likely not going to be the rates that you agreed to pay because market rates are higher than rates that an insurance company can command by giving a lot of work to a particular law firm. So the insured chooses counsel, and then in the olden days, they had to actually pay all the defense costs and then submit for reimbursement. Typically nowadays, the policies allow submission of defense costs throughout the litigation. They're oftentimes paid like every 3 months. And typically nowadays, the insurance company will pay defense counsel directly, but not always. So your company may have to be paying defense counsel and then getting reimbursement from the insurance company. And as I said, these policies typically won't cover 100% of defense costs because of the rates issue. And also reimbursement policies tend to have allocation clauses. And so we had a client who came to us and said, the insurance company is only agreeing to pay 20 cents of every dollar that our defense counsel is billing us. And I want to sue. And he basically knew all the arguments with respect to a duty to defend. And we had to explain to him, your company, which just started with a new broker who said, oh, look, I can get you this great deal. Look, the premiums are so much less. Well, they were less, but it was a reimbursement policy. And we had to explain that under the reimbursement policy, there were allocation issues, and very little of that lawsuit was covered. And therefore, the insurance company contractually only had to pay a small amount. So this was a key distinction that had not been brought to his attention during the application process. Also, satisfaction of the retention is a condition to coverage. So if you have $100,000 retention, your company is going to have to pay at least $100,000 in defense costs before the insurance company has any obligation to contribute a dollar. And oftentimes when there's an allocation clause, the insurance company will say, well, only 50% of this matter is covered. So you actually have to incur $200,000 in order to satisfy your retention. And there are legal arguments against that, but that is a very typical position of an insurance company. Finally, you need to understand the concepts of deductibles versus retentions. And deductibles, you typically find them with occurrence policies such as a commercial general liability policy. They're typically small, $1,000. They're collected from the insured, oftentimes at the end of the case when there's a settlement or judgment. And they don't affect the duty to defend. So there's going to be an immediate duty to defend. Retentions are typically larger, typically found with respect to claims made and reported policies. They can be 10,000, 100,000. I've seen $1 million retention. And the key is that retentions have to be satisfied before the coverage is triggered under the policy. Typically, there can be an exception. The California courts have recognized that where there's a duty to defend, unless the policy very clearly specifies that the duty to defend is subject to the retention, unless that clear language is in there, then the retention does not have to be satisfied before the duty to defend is triggered. But again, that's not an argument that the insurers regularly accept. And so you oftentimes have to push back on that argument.
So I'm going to talk to you now about the application process, and I'm talking both about applying for a new policy and renewal applications for existing policies. It's a good practice, and we recommend that you use a broker who has experience with your industry and knowledge of your business's unique exposures. And a good example of a situation where this wasn't clearly the case is PF Chang's and their data breach that they had back in 2014. So most of you probably recognize PF Chang's as a restaurant chain. They had a very robust cyber policy, and they had a data breach where they had 60,000 of their customers had their credit card numbers compromised. So there was a data breach, a lawsuit, class action lawsuit against PF Chang's for this data breach, and PF Chang's had a pretty robust policy. So they had coverage for that aspect of it. But where there was a gap was in the area of what's called PCI assessments. And any business that conducts a lot of credit card transactions understands that there are agreements with the credit card merchant companies that process the payments, and they have agreements that require the business to reimburse them if there is a data breach, because those merchants in turn have to reimburse Visa and Amex and so forth. So this is an obligation that the PF Chang's had, but because their policy, like most commercial liability policies, there was an exclusion for contractual obligations, and a PCI assessment is likely going to be deemed a contractual obligation. What they didn't recognize was at the time, and we were talking about this at the time that this case came out, there were endorsements available specifically to cover PCI assessments, which a business like PF Chang's would recognize is a significant exposure. And in this case, it was something along the lines of a $2 million fine that they were required to pay, and they didn't have coverage for it. So that underscores the need to have a good broker and communicate with your broker, not just once a year, but leading up to the renewal, to make sure that your broker understands any changes in your business that might affect the risk, things that might need to be mentioned in the renewal application, or changes in your business that might affect what types of coverages you need to avoid gaps in coverage. We're working with a business now whose broker sent them year after year renewal applications, and it was convenient because the renewal applications were pre-filled out and the business owner only had to apply a DocuSign signature to renew their policy. Well, the problem is that one of the questions on the application asked about the largest contract that they had in the preceding year, and from one year to the next, this business's largest contract increased exponentially to the point where the answer on the renewal application was arguably inaccurate or misleading. So that's creating a problem for coverage and an unforced error, really, something that if you take the time to pay attention to those applications, you will avoid these types of problems. The application is critical, and the best way to reinforce this point is to understand that if there is a claim, one of the first things the insurance company is going to do is they're going to carefully review your application to look for any basis they can find for avoiding coverage, if not rescinding the policy altogether. This is a very common defense that we see in coverage litigation. Even if the insurance company's primary defense is that they're relying on an exclusion, you will often see these application issues raised as a secondary defense, and it makes for very uncomfortable situations in trying to defend answers or to prove that the insurance company didn't rely on certain responses. Keep in mind that even if it's an innocent mistake, if it's a failure to disclose what is deemed to be material information, it will give the insurance company a basis for potentially rescinding the policy. So we always recommend that you err on the side of over-inclusiveness. If there's a piece of information you're not sure of and you're concerned about it, you see this happen all the time, disclose it, because yes, there is some risk that an underwriter is going to look at that piece of information and decide not to issue the policy or maybe to charge a higher premium. But that risk is far outweighed by an absolute certainty that if there's a claim, the insurance company is going to use your failure to disclose that piece of information as a way of trying to avoid coverage. Warranties are something to be careful about as well, and make sure you understand if there are any warranties. These are typically mentioned in an application. They should be clear and unmistakable. They're also referenced in the policy oftentimes. If you can avoid them, by all means, try to avoid anything that is labeled as a warranty. This is basically a representation of a specific thing that your business has done or will do, and it's stated in a way that makes compliance a condition of coverage. Think of a jewelry store that's applying for insurance, and they have a warranty that says that they're going to ensure that all the inventory that they want covered will be kept in a locked safe or vault at night. If there's anything that wasn't put in that vault and that was stated as a warranty, there's not going to be coverage for those items that weren't put in the warranty per the or put in the lock safe or vault per the warranty. Keep in mind when you're looking at a cyber policy that these applications may look like they have boilerplate language. Make sure that you have a chief technology officer or chief information security officer who's looking at those things, and make sure, number one, you understand what it is you're warranting, and number two, that you have some protocol in place for ensuring that you're complying with any representations that you may have made, because if they are clearly stated, you're going to be required to strictly comply with them. Now, items to negotiate. A lot of times people don't realize that these policies can be, they're not always, but they can be more negotiable than you might think. This is another reason to use an experienced broker, because they're going to understand which items are negotiable and which items may not be. But you have to negotiate before the policy is issued or before the renewal is issued. You're not going to be in a position to negotiate these things after a claim. And generally, the insurance companies are going to be most receptive and most flexible when they're trying to get your business, and maybe you're considering between a few options as far as your insurance renewal. Number one, maybe the most important thing to tell you is never accept an arbitration provision in an insurance policy. There's always some benefits to arbitration in certain contexts, but in our opinion, you don't want to be in an arbitration against an insurance company. It's not going to be a particularly friendly place to be. You're almost always better off in court when it comes to an insurance coverage dispute. Oftentimes, insurance companies will agree to remove these arbitration provisions. So if you can get rid of it, if it's at all possible, do so. They can issue an endorsement that basically deletes that requirement. You also have choice of counsel provisions. Really, any service provider that you want to have involved and be able to use in the event of a claim or some sort of crisis with your business. On the front end, you can typically get those consultants, whether it's, think of a cyber policy, if it's an IT consultant or a PR consultant or a law firm who you know and trust and would want to have involved in the process if something like that were to happen, get those folks approved on the front end, and you typically can do so, although there may be some negotiation as far as rates are concerned. Sublimits are an issue to be aware of. these are specific limits that apply to certain coverages. And you want to make sure that if there are any key coverages that your business is relying on and you want to make sure you have, be aware of whether these sublimits may reduce the amount of coverage that you have available for it. Think of a cyber policy. You might have a multi-million-dollar limit on your cyber liability policy, but there may be a sublimit of $50,000 for any loss that arises out of a ransomware attack or an email phishing scam, or the things that are most likely to actually occur. So if that's what you're buying coverage for, make sure that you're not getting less coverage than you think because of one of these sublimits. Exclusions, there's a lot of different exclusions, but make sure that there aren't exclusions that are going to substantially undermine the coverage that you think you're buying. A few years ago, we represented a contractor. They had a CGL policy. They were involved in a project where there was a tragic loss of life. One of the construction workers fell and died. And all the contractors and the owner and the general contractor were all sued. And this contractor had an exclusion in their policy for any type of residential construction project. And it turns out that that was more than half of the projects that they worked on were apartment complexes and that sort of thing. And so they bought a policy that excluded coverage out of the gate for almost half their, or more than half of their business. So that's something, another issue to go over with your broker and make sure that you're not having these sorts of problems. Another example would be any type of restaurant business. You probably want to make sure that you don't have an exclusion for foodborne illnesses. The retroactive date, this is going to be found in claims made policies, and this is a specific date establishing the earliest time from which the insured's activities will be covered. If you think about a service-based business, you're going to need that retroactive date to be the first date on which you performed any services that you want covered. So this is different from the policy date. So just because a claim comes in during your policy period and it's reported on time, as Cheryl was going over, if the activity, the wrongful act that is alleged to have caused the loss, if that occurred 6 years ago and your retroactive date is 5 years ago, you're going to have a problem with coverage. And you're also going to want to make sure that you maintain the same retroactive date, if possible, when you're switching between insurers. And if you're not able to maintain the same retroactive date, which should be the earliest date that you performed any activities that you want to have coverage for, that might be a factor weighing against switching insurers if you're not able to maintain the same retroactive date. Even if you have to pay a little more in premium, it's worth not creating a gap in coverage.
So as you can see, there are a lot of items that you need to pay attention to during the application process. And I know it can take a lot of time to apply for and or renew a policy. So once you do that, it's easy to kind of forget about the insurance. So you receive the policy in the mail, you open up the envelope and put it on a shelf or file it away. If it's sent to you electronically, you drag and drop it into a folder, and it's easy to just not look at the policy again until you have a problem. The problem with that is that these policies do not just impose duties on the insurance company. The insured has duties, and in order to ensure that you comply with these duties and you maximize your coverage, it's really important that you browse through the policy when you get it. As Josh said, if someone had looked at that contractor's policy and seen a very big exclusion for residential projects, they could have gone to the broker and said, hey, wait, this is a problem. So don't just ignore the policy when you receive it. Thumb through it and take a look. One of the biggest duties of a policyholder is to notify the insurance company in connection with the claim. And as I've stressed previously, tendering it immediately is very important. But what does the claim? What do you tender? Well, under a commercial general liability policy, for example, it's very clear. If you're sued, typically they cover lawsuits. Some might cover a claim, and that's defined, but typically a CGL policy covers lawsuits. So you're served and you think, oh, I need to notify my insurance company. What's not so clear is with claims made policies. So they typically cover a claim, and claim can be defined very differently depending upon the policy, but typically very broadly. So claim, particularly in the employment practices liability arena, claim will oftentimes be defined as a written or oral demand for monetary or non-monetary relief. And what that can look like is you can get a letter from a competitor that demands that you stop doing something that they say is, violating their rights, defaming them perhaps. Or you can have an employee complain, I was overlooked for this promotion. I believe it was due to certain characteristics that you can't lawfully consider. I demand that you give me that job or that you increase my pay to make up for that. So what happens is that can very likely, those are scenarios that are very likely claims under the terms of your policy. And the policy likely says you have to report that claim during the policy period or shortly thereafter. And if you have one of those scenarios in year one, and then your claims made and reported policy renews, and in year two, you're sued, oftentimes clients will come to us and they have tendered the lawsuit during year two, never told the insurance company about the claim in year one, and the insurance company denies the claim because these policies have a provision oftentimes that says if you have two claims that arise out of the same facts or circumstances, then we relate them and we relate the later one back to the earlier one. So the lawsuit is basically the same claim as that letter or as that employee's complaint. And the claim was first made during the policy year, but you did the first policy year, but you didn't tender until the second policy year. And this is a huge trap for insurance or for insureds. And the courts do not look fondly on policyholders with respect to these types of issues. The only case that we've seen reported where they made this equitable exception, and I'm convinced it's because the judges knew that that could have been them, but an attorney got a fabulous result for a client, a judgment of millions of dollars for the client. Friday afternoon, gets a call from someone saying that they're a reporter and saying, oh, your client just sued you about your handling of this case. Do you have any comment? And the attorney said, no, I don't, and hung up and assumed it was a prank. He actually thought one of his friends was pranking him because why in the world would this client sue him? Well, Monday morning comes around, he's served with a copy of the lawsuit. He immediately tenders. And the insurance company denies coverage because over the weekend, his policy expired and then renewed. And they said, well, this was a claim that you were aware of during the first policy period or the last policy period, and you didn't report it until this policy period. You're 2 days late. And the court found a very, I guess, clever and maybe disingenuous way to get around that. But it made clear that this was an outlier of a case and it would likely not come to that same conclusion in other cases, and we haven't seen that since. So these are onerous reporting requirements, and you have to understand what needs to be reported and when. Also, when it comes to tendering, you need to tender under the correct policy year. So that's fairly easy with a claims made and reported policy, not so easy with respect to an occurrence policy. And we had a scenario where a lawsuit was wrapped up, the settlement was paid. Counsel came to us and said, the client is considering suing the insurance company. Would you review the denial letter? And we did. And there were various exclusions that were put forth, and we saw ways around those. But towards the beginning of this very long letter, it basically said you tendered during the wrong policy year. But it wasn't worded quite like that. So no one really paid attention. So the question to defense counsel was, well, was this insurer on the risk 2 years ago? Because this defamation that allegedly occurred 2 years ago, and you tendered under, a more recent policy. And he said, no, this was the first year this insurer was on the risk. And we had to explain to counsel, this wasn't tendered under the correct policy. It should have been tendered under the policy in effect 2 years ago when the defamation allegedly occurred. And so too often parties treat the occurrence policies like a claims made policy, and they tender to the current insurer. And you need to look at, when did the accident happen? When did the damage occur? And those are the policies that you want to target. And sometimes a tort is continuing, so you may have multiple insurers on the risk. So if you're tendering under an occurrence policy, you need to tender under every single possible policy that could come into play. Also, so don't overlook excess policies and umbrella coverage. So if you think a claim is going to approximate the limits, especially if you have a burning limits policy, you need to be putting your excess carrier on notice, and also umbrella carriers, which typically provide broader coverage. So it's not unusual for the underlying insurance, maybe a primary CGL, not to cover the occurrence, but an umbrella policy above it actually provides broader coverage and has a duty to defend. So it's not unusual for an umbrella carrier to step into the shoes of the primary insurer. Also, going back to tendering under the correct policy year. So, oh, I already said it. Okay, forget that. Okay, so the consent clause. So I've talked about how if you don't tender, you can't get pre-tender fees and costs. But these policies, these no voluntary payment provisions in these policies also affect post-tender fees and costs. So what we will sometimes see, particularly when it's independent counsel that isn't panel counsel typically knows you have to get insurer approval for everything. Independent counsel, not always so great. So what you don't want to have happen is your independent counsel, or maybe if it's a reimbursement policy, the counsel that you've hired goes out and hires an e-discovery vendor that charges, you know, hundreds of thousands of dollars to hold your data and make it searchable, or commits to a mediation and then goes to the insurance company and says, oh, here, you need to pay this. You may find the insurance company saying, well, we have our own e-discovery vendor, and that vendor is significantly cheaper, and you should have asked us. We haven't given consent, and now you're on the hook. So you don't want to have that happen. Also, do not make or accept an offer without consent. This is something that we repeat so often to defense counsel, and they say, yeah. And then they come back and they'll say, oh, we settled, so now we need to get the insurer's consent. And you do not want to be in that position. You want to not surprise the insurance company. You need to say, we think this is a good time to settle. Here's what we're thinking is an appropriate amount. We want your consent to offer this, or we've received this offer that we want to accept. Because if you don't do that, you're very likely to end up with problems as far as the insurance company agreeing to cover the settlement or judgment. And we actually had that in a case where the insurance company's panel counsel made an offer, and it was made very clear to the client, you can't make or accept an offer without the insurance company's consent. The defense counsel basically said, oh, it's okay, we're going to do this. And then there were problems that we ultimately resolved, but there were problems with the insurance company covering the settlement. So you don't want to be in that position. Okay, so if you have a duty to defend policy, there's certain things you need to understand about that. The duty to defend is an immediate duty. The insurance company should be providing you counsel that will get a answer or an answer on file. And if not, the insurance company risks breaching the duty to defend. The standard for defending is quite broad. It's a potential for coverage. So if there's a potential that the claim is not covered, the lawsuit is not covered, then there's also a potential that it is covered, and then there's a duty to defend. It's important to keep in mind that just because the alleged causes of action may not be covered, that doesn't mean that there's not coverage. So oftentimes, if you carefully read the complaint, woven in there are allegations of, for example, defamation. And under a general liability policy, defamation is almost always covered. So if you can find allegations of defamation and show the insurance company that your company is potentially liable for conduct that resulted in a defamation type injury, then you can likely get coverage. Also, keep in mind extrinsic evidence. So that can be used to establish a duty to defend. We had a client who was sued in a potential class action. The way it was alleged, it appeared, the insurance company understandably believed that the claim was brought on behalf of contracted workers. And the policy specifically excluded claims brought by contracted workers. But the client explained that it had 4 or 5 W-2 employees that were actually technically a part of the proposed class. And so we presented that evidence to the insurance company, and it changed its position and agreed to defend. Typically, the duty to defend extends to the whole entire lawsuit. And so the case that established that proposition involved 16 causes of action. Only one was covered. And the court said, yes, the insurance company must defend the whole entire lawsuit. And then at the end, it has a right to reimbursement if it can prove that certain amounts were incurred to defend solely uncovered claims. And this is typically a difficult standard to meet. I mean, there are times, we had one case somewhat recently where there were very clearly uncovered causes of action that were subject to a preliminary injunction. And hundreds of thousands of dollars were pursued defending against this preliminary injunction, and none of that was covered. And the other covered causes of action were actually stayed pending that. And so had the case concluded through litigation, had we not come to a resolution with the insurance company easily could have brought a reimbursement action and could have received back all the amounts that it paid solely to defend against this preliminary injunction. But that's very rare. Also, it's possible that the duty to defend can extend to a counterclaim if the prosecution of the counterclaim will act as a defense to the claim against the insured. And the duty to defend terminates when limits are exhausted or there's no potential for coverage, because the insurance company learns of facts that make it clear that there's no potential for coverage. The duty to defend is limited or it ends when the limits are exhausted. So keep in mind that you may want to try to keep some limits in a policy where it's not a burning limits policy or even a burning limits policy, but you may want to try to save some limits. So if you have a claim and there's an opportunity to resolve it for $1 million, and you suspect there may be another claim coming down the pike that would otherwise be covered by this insurance policy, you may want to try to keep at least $1 of limits available so the insurance company has a duty to defend.
So when an insurance company defends under a duty to defend policy, almost always it will be done subject to a reservation of rights. And many of you have probably seen these reservation of rights letters. They're very lengthy, and they will quote all of these policy provisions that the insurance company believes is relevant to the coverage analysis. And oftentimes the insurance company will reserve its right to deny coverage in the event certain exclusions are triggered. And one of the most, the classic example, which would create a right to independent counsel, is where there are negligence allegations, but also allegations that maybe an insured officer acted intentionally or in a deliberately fraudulent manner. So if you have that situation where someone's alleged to have engaged in both negligent conduct and intentional conduct, you have one scenario in which liability can be found, which will be covered under the policy, and the intentional acts will not be covered. So if they're found to have engaged in intentional misconduct, there's going to be no coverage. In that situation, the appointed defense counsel has a conflict because they have allegiances to the insurance company. And from the insurance company's perspective, if liability is found, they'd prefer that it be on the basis of an intentional act, so they don't have to provide indemnity coverage. In that situation, the defense counsel has a conflict of interest, which gives the insured the right to independent counsel, which means the insured can select the defense counsel they want to use, and the insurance company will have to pay for that counsel, although they will only have to pay the rates that they would generally pay their panel counsel. So this right to independent counsel doesn't just arise when there's allegations of intentional conduct. It really involves any time the applicability of the exclusion turns on an issue that it's disputed and will be decided in the underlying case. That's probably going to give you a right to independent counsel. So one other example, a few years ago, we were representing a client in coverage litigation while the insurance company was defending. And one of the insurance companies, one of the exclusions they relied on was this regulatory exclusion, because there were allegations in the case that suggested that the client may have violated a particular regulation. And if they did so, that would potentially trigger this exclusion. But in any event, the regulation only applied in the absence of an agreement. And the client's position was that they had the agreement that got them outside of the applicability of this regulation. And that's getting into a lot of detail, but the bottom line was the applicability of this exclusion was going to turn directly on an issue that was disputed and being litigated in the underlying case, and we demanded independent counsel on the basis of that, those allegations, among other things. The conduct of one insured, you want to make sure that your policy in situations where the company and multiple officers or directors are sued, a lot of times policies will have provisions that are referred to as a non-imputation provision that suggests, let's give a hypothetical where there's one bad actor at the company who engaged in some intentional or fraudulent conduct. And there's a number of other folks who are sued because they were alleged to have been negligent in failing to supervise or failing to, or negligently retaining this individual, whatever the case may be. You don't want a situation where that intentional act on the part of one officer negates coverage for everybody. And so these non-imputation provisions will generally provide that the knowledge or conduct of one insured is not going to be imputed to other individuals who we refer to as innocent insureds. That's generally found in D&O policies. Make sure you have it. Although in D&O policies, the knowledge of the CEO is typically going to be imputed to the corporation. In California, insurance companies have a duty to settle. It requires the insurance company to resolve a claim whenever the insured has real exposure that exceeds the policy limit, and there's a reasonable opportunity to settle within that limit. So let's say it's $1 million limit. There's an offer that comes in either for the policy limit or below, and the internal calculations are that the insured is exposed to something north of $1 million. That's a reasonable opportunity to settle within that limit. The insurance company has an obligation to accept that, generally speaking. If they don't do that, there's going to be exposure for the insurance company. And a good example is a situation we helped with a couple of years ago. We represented a nonprofit who was engaged in an employment litigation. They had terminated an employee several years earlier, and well before we got involved, the employee sued for employment discrimination. The nonprofit had an employment practices liability policy that was a burning limits policy, like the type that Cheryl referred to earlier. And the defense firm that was appointed by the law firm burned through a lot of that policy. And it turns out, what we found out after we came on board was that early in the case, the plaintiff moved on from one lawyer and was about to hire another. But before she hired the second lawyer, she reached out directly to the defense firm and expressed an interest in engaging in settlement negotiations. And she actually sent a settlement offer, which was clearly like an opening offer. It wasn't her final offer. And it was well within the limits even then, because not much had been burned off the policy. But rather than take this seriously, even though they knew that the insured had some significant exposure in the case, they blew off the settlement offer and they continued to defend the case. Fast forward something like 3 years later, the case took, I think, almost 4 years to go from the beginning to trial. The nonprofit ended up being hit with a multi-million-dollar jury verdict. And of course, at that point, almost all of the available limits had been depleted by the defense costs. So the insured is now in a situation where they have this multi-million-dollar judgment against them and no available coverage. Thankfully, we knew about this earlier settlement offer, and we used that to negotiate with the insurance company by pointing out that the insurance company was going to be potentially exposed to the entire judgment as damages for bad faith, even though those damages far exceeded the policy limit. Keep in mind that if there is a breach on the part of the insurance company in general, the damages are not necessarily limited by the policy limit. Pre-litigation demands, this is something that came into effect a couple of years ago. If you're ever in a situation of either receiving one or serving one, there's a Code of Civil Procedure section that lays out certain requirements that have to be met in terms of information that has to be provided along with that pre-litigation settlement demand in order to potentially trigger this exposure for bad faith if the insurance company unreasonably rejects that settlement offer. Hammer clauses are generally found in professional liability policies. This is a situation where in those policies, the insured can object to a settlement and the insurance company cannot settle over that objection. So if the insurance company receives an offer and the insurance company believes that the offer is reasonable, it's within limits, and the insurance company is just tired of paying for defense costs in that case, they really want to settle. If the insured objects and doesn't settle and basically prevents that case from settling, either based on principle or some other reason, these provisions will provide that the insured will be responsible for some or all of any amount awarded above the proposed settlement amount. So let's say there was an offer to settle for $500,000. The insured on principle said, no, I didn't do anything wrong. And fast forward, there's $1 million judgment. Depending on the terms of the hammer clause, that insured is going to be responsible for some or all of that additional $500,000 that was awarded above the settlement amount. Now, never take an insurance company's denial at face value. We can tell you that you'd be surprised to learn how many times insurance companies simply reverse their positions when they get a letter calling them out on an unreasonable coverage position. It may be that they're not looking at all of the parts of the policy and ignoring certain policy language, or ignoring case law on point that directly contradicts their position. Whatever the case may be, it doesn't always require litigation to get insurance companies to change their position. And your recoverable damages, if there is a wrongful denial and you're forced to fund your own defense, you're entitled to recover defense fees and costs, any amount paid in a settlement, potentially any judgment, those types of things. And also be aware that even if you've just recently concluded a litigation, either by settlement or a judgment, if that was reached within the last 4 years, because the statutes of limitation for your contract claim and your bad faith claim are told during the underlying litigation, you can go back sometimes several years after the fact and still pursue an action against the insurer if the denial was wrong. So if they denied coverage on the front end and you had to go pay for your own defense, that recovery is going to include prejudgment interest on your defense costs from the date of each invoice. So if you had a litigation pending for 4 years, and then it's told during that time, and then fast forward, you have you go to the next slide. You have a couple of more years go by, and then you sue. You still have the ability to recover these amounts, and that's prejudgment interest can increase pretty significantly and ends up being a substantial component of our clients' damages and generally provides a lot of leverage for settlement. So if you've resolved a case recently, anytime, and if it's within the last 2 years, you could still pursue damages for bad faith, which would include a majority of the defense or of your attorney's fees incurred in pursuing that action against the insurance company. Those fees are referred to as branch fees, and without getting into the details of how those fees are calculated, generally speaking, it's going to be the majority of the fees will be recoverable if there's a finding of bad faith. So if you've resolved a case recently, it's worth having a coverage attorney take a second look at the insurance denial from several years ago. You may be sitting on a valuable asset. We have a couple minutes left if there are any questions, but otherwise, thank you again for the opportunity to be with you today.
Thank you both. There were no questions in the chat, but if anybody has any questions, feel free. We do have a couple more minutes to speak up right now. Okay, well, thank you very much, Josh and Cheryl. It was super informative. We were appreciative of your time and your expertise, and we hope everyone has a great day.
Thank you.
Thank you very much.
Take care.
Bye-bye.